Welcome to Break Away from the Rat Race, a podcast series to awaken your entrepreneurial spirit and help you achieve financial freedom. On our show, you'll learn about investments and how to create passive income. Let's get started with your host, Eric Martel.
Welcome back. Today we're going to talk about opportunity zones. So I had a lot of questions about opportunity zones. It's something that's pretty new that was created by the Tax Cuts and Job Act, and so people are still kind of looking for information on that, and so I'm hoping that I will be able to shed some light at least to determine if this is something that you should look at in more details, or if this is something that you're just not you don't have an opportunity really to use the opportunity zones. So disclaimer, I'm an entrepreneur and a real estate investor, so I am not a financial advisor, an accountant, or a lawyer. So I'm just sharing my personal opinion. If you want to use opportunity zones or any other of my advice, please seek professional assistance before doing so. And every situation is different, so that's why you need to seek professional advice before making your own investment. So what is an opportunity zone? So opportunity zone is an area that was designed by each state where they wanted to have additional economic development. So it's really, you can find an opportunity zone maps, and it's going to identify which census tract or which area of the map is part of an opportunity zone. It was designed to drive long-term investment into the rural and low-income communities, and it was created by the Tax Cuts and Jobs Act of 2017, and all these investments, you can't just go and invest directly into this. For each of these investments, they have to be invested through something that's called a qualified opportunity fund. And what is a qualified opportunity fund? So it's a new class of investment. So that's created by the Tax Cuts and Job Act, and it's basically specifically designed to invest in opportunity zone. So, but it's the same kind of organization. It's still, you can still use a corp, you can still use an LLC, a partnership, in order to do that organization. So from that perspective, it's the same. It's just that you need to have some special wordings in your articles of organization or operating agreement that basically says, that this particular organization, corporation, or LLC is designed to invest in opportunity zone. So that's the opportunity fund. But what about that qualified part? So how do you qualify? So you have to have at least 90% of your fund asset invested in an opportunity zone. So that's the qualifying criteria. You can invest in businesses. You can be that qualified opportunity fund can invest in partnership and all kinds of different things. But for the real estate, I'm really focused on real estate investment here. The fund must significantly improve the asset by basically investing an amount greater than or equal to the amount or the cost basis of the structure, and that amount of money needs to be spent over the next 30 months. So you actually have to do a schedule of how much money will be spent over the next 30 months, and then you want to make sure you're on track for that, to spend that amount of money for that period of time. So if you don't meet these criteria, then you are not qualified opportunity fund, and you should really be looking at a different vehicle in order to invest in that area. It might still be a good opportunity to invest in there. In fact, we do have an opportunity that an apartment building we invested in that is located in the qualified opportunity zone, but we're not doing significant rehab to the property, but not to the extent that is required by the qualified opportunity fund. So we're not using that vehicle in this case. So that qualified opportunity fund invests in an opportunity zone property. As I said, it could be a business, so it could be via stock or partnership, into a restaurant, into all kinds of different businesses that is located in the opportunity zone. But it could also be a tangible property. So such as real estate. So this is what we're really particularly interested in, and what most people are interested in terms of the opportunity zones. But there are two tax benefits why we are interested in opportunity zone. The first one is a temporary tax deferral for capital gains that you invest in qualified opportunity fund. So, and you can get up to 15% of the original investment that basically eliminated from taxation, basically becoming tax-free. So as you can imagine, there are some strings attached to that. So if you sell your investment after 5 years, you would get only 10% of that would be eliminated, of your original investment would be eliminated from taxation. So you would have to pay taxes, capital gains tax, on 90% of that original investment. If you wait 7 years before selling, then you would reach that 15% elimination, or pay 85% on that original investment. So if an investor holds their investment up until December 2026, no matter what, whether they hold or they sell, they would have to pay taxes on 85% on their original investment. So this is a trigger point at 2026, you have to declare your 85% of your capital gains, and you have to pay taxes on that, whether you still hold that investment or whether you're selling it that year. The second tax benefit is that the profit made by the qualified opportunity fund is tax-free if you hold your investment for 10 years or more. So this is something that's very interesting and very important, obviously. Example. So I just thought I would look from the taxpayer's perspective and come up with an example of what the opportunity zone would look like with some real numbers. So let's say on September 1st, 2018, a taxpayer sells his apartment building for $1 million. So here we're going to have the gains right here, $1 million. And then the next thing is that they want to invest in a qualified opportunity fund, and that qualified opportunity fund will buy an apartment building that needs obviously significant renovation. So I was looking for an investment where we could really use maximum leverage on that $1 million. So what kind of property can I buy for that? So while maintaining basically pretty much zero cash flow, I don't want to have to put more money into it than necessary. I want to make sure that my rehab cost is at least equal to the amount of the structure, and then that's why I came up with the purchase price of about $1.4 million, and then having to do a rehab for 1031, and then being able to use maximum leverage, 60% of the purchase price plus 100% of the rehab cost in terms of financing, and then paying assuming some gross rent, using an 8% cap for the net operating income to pay the loan, so that we end up with a net cash flow of zero. So that's how I came up with that purchase price. And then that works out pretty good. Then the next thing that I want to look at is it's going to take a certain amount of time to stabilize the property. We're making $1 million in rehab in a building that we purchased for $1.3 million. So I'm assuming that after 2 years we can really increase the rent by 75%, so which is pretty significant. And then we have a different NOI here for after stabilization. All right. Now, as we mentioned before, so this is our investment. We have an apartment building. We finished the rehab after 2 years. The rents are up 75%. Our NOI is $192 compared to what it was, $110,000 after 2 years. I think that's pretty good. That's a pretty good deal. It sounds very good to me. So next step, 2026. You have to pay taxes, 85% of the original investment, or so on $850,000. I'm assuming like a 30% tax bracket, so you're going to have to pay $255,000 in 2026. So your money is still in the qualified opportunity fund. So you're going to have to come up with that money. And then, so assuming you have that money, then you're going to sell that property. So we bought the property at 8% cap. I'm assuming that we are the significant amount of rehab that we've done, and I'm assuming that the neighborhood is getting better and all of that. Then that we're going to sell at 7% cap rate. So obviously an improvement in the property and the situation. I'm also assuming that the NOI is increasing 2% per year, which seems to be kind of like the average that I looked at online. And then basically all of that, the sold price, assuming the 7% cap rate, would be $3.2 million. And then that would be for a total gain. When I look at the amount of money I put in, if I look at there was no cash flow, obviously, but if I look at the taxes that I paid as well, I would end up with a gain of $815. And then I would pay taxes. Actually, in this 815, we don't take into account the tax payment. So we just look at the property, the purchase price, the rehab costs, how much we sold it at, and then calculate the gain this way. There's no taxes, so it's still the same amount of money. In the net cash after tax, so this is when I take into account the $255,000 that we paid in 2026. So when we look at all this, we end up with a 4.6% annual rate. Over a 10-year period, we end up with 4.6% annual rate. So this is where we are as a taxpayer. So an example of that. So there are some risks to that. I mean, if you're just a taxpayer and you want to invest in a qualified opportunity fund, you want to make sure that you vet the managers of the qualified opportunity fund. So it's pretty new for a lot of people. So you want to make sure that you're going to go with someone that is at least familiar with development or significant rehab on some of these properties. You will still have to pay taxes in 2026. So you have to be prepared for that. There might be some risk also that the neighborhood itself is not improving as much or as expected. So if you're expecting that, so that may affect your cap rate at sale time. So this is something that you need to look into. So there are also many unanswered questions. So this law is fairly new, or this vehicle is pretty new. So there are a lot of questions out there. What happens and what if this happens? And so this is what we have to look at, and how this will be addressed by the IRS. So this is something that will have to be. So it's an unknown really that you can't really plan for, but it may affect your taxes unknowingly, right? So yeah, you have to look at that. If you have, you may want to look at a lawyer, talk to a lawyer or counsel to basically figure out if this is something for you in here. Now, I want to look also at compare. So opportunity zone seems pretty good. What about 1031 exchange? How does that compare to 1031 exchange? Right, because right now I sold an apartment building in order to invest in a qualified opportunity fund. That was my example as a taxpayer. So now I want to look at what does that look like if I was, instead of doing that, I was doing a 1031 exchange and still get all my cash out, right? So I still have my gain of $1 million, right? And then so the same gain here, but then I'm going to do fully leverage, but on a stabilized building. Of course, I could invest in a value add building. That would be great. I just thought I would do it as just to make it simple, as a fully leverage on a stabilized building. So you would be able to get 80% in financing, and then basically you invest in the apartment building, so you have gross rent, net operating income, I'm assuming again 8% cap, net cash flow per year, and then you pay taxes on that net cash flow, so again 30% bracket. So you'd be making $60,000 or so in net cash flow from that property. And then so there's no stabilization, so the gross, the net NOI after stabilization is the same as before stabilization. So no changes there. In terms of the rest, we sell at 8% cap. So you remember that when we did the opportunity zone, because we were doing so much rehab to the property, we thought that we would be able to sell the property at a 7% cap rate. Here is the same cap rate that we go in as when we sell. So 8% cap rate, and then we pay taxes on that 8% cap rate. So this is our gain, and this is after tax what we have. And normally the taxpayer, they wouldn't sell the property. They would basically do another 1031 exchange into a different property if this is what they choose. So they would basically leverage like basically the $1 million equity plus their gains, and then they would put that into another property. But instead, we're assuming here that they're going to sell their property and get everything out tax after tax, just like we did for the opportunity zone. So we have our $1 million, we have our $600,000 profit, and we also have the $60,000 in cash flow that accumulated over 10 years. I'm assuming actually 0% interest on that. So you end up with $2.2 million on that one, and an 8.3% annual return. So it's significantly better. And not only that, but I'm just buying a stabilized property. I'm not even looking for a value add property. I could do better if I was to look for a value add property. But I just thought I would keep it simple, no problems on the 1031 exchange, because that's often what they would do. They would find something that's stabilized. So that's my comparison between the two. So obviously 1031 exchange significantly better in this particular scenario when we compare the opportunity zone and that. It may be different in other scenarios. For example, if it's a completely off the ground development in opportunity zone. So you have to look at the opportunities obviously, but I just thought I would share this particular example with you. So how do we take advantage of that as a taxpayer? So for my thinking is that for gains that don't qualify for 1031 exchange, so if you sold your primary residence, or if you had stock market gains, really you don't have much choice. The opportunity zone is the only way really to do tax deferment. There's really nothing else. So, but for gains that qualify for 1031 exchange, so you kind of have a choice here. So you may still look at 1031 exchange and see what that looks like, because you don't have any time limit on the deferment. You don't have to pay taxes at the end of 2026. And then you can also, you don't have to wait 10 years. With my 1031 exchange, I can basically sell the property or do another 1031 exchange after 5 years, and there's no tax impact on me. So it's a lot more flexible. And then you can do additional deferment after your initial period into a 1031 into another property after that. So as opposed to the opportunity zone, you ended up all after tax dollars that you have to reinvest. So you have a choice to make if your gains qualify for 1031 exchange. So look at the opportunity and really walk through the scenarios and make sure that it makes sense in your particular situation. As an investor, a real estate investor, so how do you take advantage of the opportunity zone? Well, I'm thinking that you have really two options here. You can really say and decide that you want to do opportunity zone. You're very serious about it. And my recommendation is that you have to define a specific strategy to use opportunity zone. It's a completely different animal, and so you have to really look at it as a different type of investment altogether. So, and there's a couple of reasons. First of all, there's the opportunity zones themselves. So if I normally we look at different markets and different areas and kind of a neighborhood, and then we focus on that. In this particular case, you want to look at the opportunity zones, and you want to find the best opportunity zone that would offer the maximum potential for the kind of business that you are doing. The other thing that you want to look at is really kind of identify and define the investment criteria. Now that you have the market, the opportunity zone, what's the median price there? What kind of a neighborhood is it? What kind of property should you be looking at, and etc. And then really looking at all the example, all the numbers. I mean, to identify what are the criteria for the investment that's going to be profitable for you and your investor. And finally, can you find the right capital? So it's not. It's a little bit easier to find people that have 401k money that want to invest with you, or people that have cash that want to invest with you. Now you have to entice people that have capital gains, either on their primary residence or stock market, that want to leverage the opportunity zone. So they would be particularly eager, I would think, to do a tax deferment on their gains that are non-1031 exchange, and to invest that in opportunity zones. So you have to find that capital. So if you're not already connected with these kinds of investors, then this is something that you're going to have to do. Otherwise, you're not going to, you're going to have to find a completely new source of capital, and that could take a while to network into this group of people. Otherwise, the other strategy, if you don't already have that, is to basically maintain your current investment strategy and just be aware that the opportunity zones are out there. And if you find something, an opportunity that would be appropriate for an opportunity zone, then that just adds another potential avenue, basically for funding your project, or for moving forward with an investment. So there's just something that to be aware of in that particular case, instead of building a whole strategy around that. So this is all I had today. If you have any additional questions, feel free to reach out to me, and I'll try to answer them as much as I can. Thank you very much, and we'll talk to you later.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.